Hello and welcome. Very interesting video today covering a cascade momentum trading strategy on the NASDAQ equity index constructed in Python. Background: Federico was reaching out to me and offered me a trading strategy in exchange for cash. I counter-offered. If he shares the trading strategy with me, I will backtest it and make a video about it. So he did his part of the deal, now it's my turn. So what's the strategy? Momentum NASDAQ. Trade frequency monthly. Select best 50 stocks over the last 12 months. And out of those, pick the best 30 stocks over the last 6 months. And out of those again, pick the best 10 stocks over the last 3 months. So as said, kind of a cascade timeframe strategy. You are picking a basket, then filter the basket and filter the basket again on different timeframes. At least in my viewpoint, very interesting strategy in terms of coding. So Federico, thanks a lot for sharing. Grazie. Federico was explicitly asking to exclude the survivorship bias. I won't fully get rid of the survivorship bias in this video, but at least I'm trying to diminish it. If the video gets enough traction, I will also fully exclude the survivorship bias, but this video is more than enough input for now. Let's take a quick look at the equity curve shared by Federico, and all credits go to the Italian author Luca Giussi. The strategy is from this book. I won't even try to read it out. So this is the equity curve. So as you see, the strategy clearly outperformed the benchmark, the NASDAQ here. All right, let's get started. We need some libraries. Pandas for data handling, why finance to pull stock prices and index price data from the internet, and NumPy for calculation purposes. Next, I need all stock ticker symbols which are currently in the NASDAQ. And I'm using Pandas' convenient read HTML function and provide a Wikipedia link to read them out. And this is just the 5th table on this side, and I'm getting a data frame with that containing all ticker symbols which I need to pull price data for them. So this is as of today, right? Or as of the last day this was updated. So as said in the beginning, this is full of survivorship bias currently. So let's store that as ticker.df, and let's just take the symbol column here and convert that to a list. So now we have all ticker symbols in a list, and let's store them in tickers here. And now we are just pulling price data for all those tickers, and I'm storing that in a new data frame df, use yf download function, provide my tickers list, and we are just starting the analysis in the beginning of 2010. And I'm already interested in the adjusted close. With that, we are getting a data frame containing daily price data, close prices, for all NASDAQ ticker symbols. And what you see here, so you see the columns are the companies, Apple, Airbnb, and so on. And here are daily prices, so over 3K rows here, right? Now, what you're seeing here is that Airbnb has an NAN value here. Reason behind that is Airbnb wasn't traded on a stock exchange back then. Same for Tesla. Same for Workday or whatever that is here, right? And what I'm going to do is I'm going to exclude those from the analysis. The objective is diminish survivorship bias. So the thought behind removing those is, if the stock wasn't traded on an exchange back then, it couldn't be in the NASDAQ. Of course, at some point in time, the stock became a NASDAQ stock, and you have to consider it from there on in your analysis. But as said, this is a simplifying way to at least diminish the survivorship bias. To fully get rid of the survivorship bias, you need to exactly know at each portfolio formation date which stocks were in the NASDAQ. I've covered that in one of my previous videos, and I will show you how to do that in a follow-up. But for now, I'm excluding those. So be really aware what implication these removings have. So how am I removing them? I'm just dropping all columns which have NaN values. So just using drop NA and provide axis 1. So with that, you see that we only have 80 columns left. All right. So we have daily price data. Next, we want to resample the data and calculate monthly returns. Why monthly returns? Because we need a 12-month return, a 6-month return, and a 3-month return, right? First of all, I'm calculating a monthly return, and I'm storing that in MTL for monthly. Use df, then calculate relative changes. So I'm going to show you step by step. It's easier to understand then. So you see I'm getting the daily returns with that, and then I'm simply resampling them on a monthly base and take the product. So if you don't understand it mathematically, please check out a video which I will link in the video description, how to accumulate returns here. So I'm also dropping this first row here because it's containing NAN values. But these daily returns are resampled, and then I'm just taking the product to get the cumulative return. So I'm going to use df percentage change to get the daily returns, add a 1 to that, exclude the first row as it's containing NAN values, and then I'm resampling that on a monthly base and take the product. With that, I'm getting monthly returns. So let's take a look at that together. And as you see, in January 2010, Apple lost roughly 9%, right? So if you take this number, subtract the 1, Apple lost roughly 8.9% in this month. And if you understand this, you can skip the next part, but I'm going to show you exactly how this number or where this number is coming from. So if we take a look at our data frame and want to know our January return, we're taking the last price in December and then the last price in January. So we don't see it currently here, but it should be here. This is the last price in January. And now to have the return in January, I'm just setting the return into relation to, the price into relation to the price at the end of December. And this -1 is exactly this number. Okay? So this is how you calculate monthly returns in quotation marks manually. But as you see, now we have this beautiful data frame and we have a monthly return for each month, January, February, March, and so on, for each company here. Next, I want to have a function which is calculating the 12-month, 6-month, and 3-month returns. So I'm going to define get rolling red, because in the end you're just rolling over the monthly data frame, and provide the rolling window, and the rolling window is just the month you want to roll over. So this is taking a data frame as an argument, and n for the month you want to accumulate. And then this is simply returning the f rolling over the provided window, and then you're just applying the product. So this is again just accumulating returns over a certain window. So if I'm calling this function here, get rolling red on my monthly return data frame and provide a 12 here, I'm getting the 12-month return of all symbols here. So of course the first 11 rows are containing NaN values because you cannot go back from there. But if we are taking a look at the first 12 rows here, you see that the last one is containing the cumulative return over the last 12 months. So you could again take the Apple price at the end of December here and compare it with the Apple price at the end of the last December here. And you will get the exact same number. Okay, so this function is doing that for us. And now I'm simply creating 3 different data frames. I'm getting a 12 return data frame, a 6 return data frame, and a 3-month return data frame. And here I'm simply providing 12, then 6, and then 3. So why am I doing this? The main reason is that are performance reasons. So you could calculate the returns every single step again when performing the analysis. But why do so when I have to calculate it one single time and then I'm just screening those data frames? This is just more efficient, so this is why I'm doing that. So with that, I have 3 data frames containing the 12-month rolling returns, 6-month rolling returns, and 3 months rolling returns. Rolling returns sounds so complicated. It's simply the 3 months return. And this is simply the 6-month return. And this is the 12-month return. So how did the asset perform over the last 12 months, 6 months, and 3 months? All right. Next, we are going to construct this so-called cascade. And before wrapping that into a function, I want to do that step by step. I think it's easier to understand. So first of all, I want to have my top 50, right? And my top 50 are my 12-month return top performers, right? So I'm just screening for a particular date. So let's say December 2010. So with that, I'm getting the returns here over all 80 columns on December 2010. So these are the returns over the last 12 months for all those assets. So as you see, Apple was rising by 53% over the last year. This was dropping and so on. And now I'm simply sorting this and find the 50 top performers by applying n largest and provide 50 here. And with that, you see that I'm only getting the top 50 performers here. All right. So if I want to have the stocks here, I'm just taking the index of the series, and these are my top 50 performers over the last 12 months. Okay. So I could store that, what I started here, in top 50. Now I have my top 50. And I can use this now to screen my 6-month return for those symbols on that date. So let's do that. Let's call that top 30. Use red 6. Look for that date here. And then only for those here. So these are the columns I'm looking for. And then again, pick the 30 largest. And with that, I'm getting my top 30 over the last 6 months, given that they are the top 50 over the last 12 months. All right. So again, I can just take the index now to get only those symbols here, and then essentially do the exact same thing for the top 10 again, taking my 3 months return. So taking this one, then top 30 again, and largest 10 index, and with that I have my top 10 symbols. This is how it works. So let's wrap that all in a function, just calling that get top for a given date. And then I'm just essentially doing the exact same thing which I did here. So taking top 50 first, replace that by a given date, then top 30, replace that by the date as well, top 10, replace that by the date, and in the end I'm returning my top 10. So if I'm calling that get top for, let's say, this date here, I'm getting those symbols here. And with that, I am getting the top 10 symbols given the 6-month and the 12-month return for a particular date. Now, what I just need is how the portfolio performance of those stocks is. And if I'm in the end of December 2010, as an example, I want to buy this portfolio and hold it 1 month, right? So I want to know how did this portfolio perform in January 2011. Okay, so I will also do that in a function, but I'm going to show you step by step. So how can I do that? I'm simply screening the monthly return data frame for those symbols here. Quite a similar approach as I did within this function. So I'm taking my monthly return data frame, screen for, let's just take this date, and then let me give you a small trick here. So if I'm taking this and slice that like this, I'm getting the next date here. So what am I doing? I'm slicing the monthly return data frame from this date on, including this date, to the end of this data frame, and then I'm just slicing for the next row here. With that, I'm getting the next date. You can also work with add a month to that, but I think this is the most convenient way to get the next date, and you don't have struggles with transforming the dates and making sure that you really got the next date here. So this is a good way to do that. I'm simply getting the next date in the data frame with that. So I just need the returns for those symbols now, right? So I'm simply providing those symbols here, or I could also just call the function, right, and get the symbols. So you see, I'm just getting the returns for, so the monthly returns in January for the portfolio formed at the end of December 2010. And you see these are the returns. So for an example, SWKS was rising by 10%, and so on, right? So I could just define that as my portfolio, and my portfolio will be constructed in a way that I'm just equally weighting those assets. So I'm just taking the mean return of this portfolio. So I can just take mean over x is 1. So I just want to have the mean over all those columns here. And I'm getting a portfolio mean of roughly 4% here, right? So if I only want to get the value, you can also do it like so. All right. So this is the portfolio return on that day. Let's wrap that in a function that is more convenient. Let's call that portfolio performance for a given date. And we are just doing what I did and replace some stuff here. So this is the date, and this is also the date. And that should be fine. So we are just returning this to get the portfolio mean. So again, portfolio performance on this date would be 4%, right? So if you want to have it raw, you can also subtract a 1 here. So let's test this strategy. So as you can imagine, we're just looping over all dates, and then we have the performance of the strategy. So I'm going to store that in a list here, then I loop for date in, and then I'm simply taking our monthly return data frame and go until, let's go until November, because December is not finished yet, right? So we're just taking until the row before the last row here. So for date in monthly -1, and then let's just loop over the index here. So these are all our dates, which are our portfolio formation dates. And then we are simply appending to the returns, calling our portfolio performance function on the provided date. So with that, we are getting the returns on each portfolio formation date. All right, so let's execute that. With that, we are getting a list. So of course, first ones are NaN values, because we don't have returns back until then. And then we are getting the returns for the dates. So let's transform that to a series, easier to analyze, and also set an index. So let me think about what would make the most sense. So the last time we constructed a portfolio would be in the November, I guess. Let me quickly check. We are evaluating in the end of November, and our portfolio performance would be the December return. So I'm just setting the index to monthly index from 1 on. So my December portfolio return would be 0.96 until now. Okay, so to have the equity curve, I can take the cumulative product here. And as you see, this insane return here, right? So if you plot it, you have this equity curve here, which is insane, right? So that means 20x, right? So close to the numbers from the author, which was including some stuff like slippage and so on. So if you want to have that included, you could just take, let's just subtract 1% for everything for iron returns. Then you have the strategy given 1% trading fees, commissions, and so on. So even then 6x here. But anyhow, so you could also, what I just thought about when taking the portfolio performance, what would be better is to, let's quickly do that, is to just take the date as here, because this is the date you are forming, or you're evaluating the portfolio. So instead of taking just the values, you can also take the dates from here and form that. But it doesn't make a big difference. So I was just thinking of how you can do that here with an index. Anyhow, let's do the performance comparison. So let's create a NASDAQ data frame. Download NASDAQ data. So this is the ticker symbol for NASDAQ, starting in the beginning of 2010 as well. Getting this here. So let's take the adjusted close and accumulate returns. So add a 1 to that and accumulate the product. So 4x, 4x. So if we take a look at the plot, you see the NASDAQ development. But finally, as you saw, this strategy was even taken trading fees into account with 1%, which is quite too much, at least in my experience, my opinion. This strategy is in fact outperforming the NASDAQ. And just one last comment. So by taking the companies like Airbnb, Tesla and stuff like that, so I fully excluded them. Of course, they have a highly positive impact on the strategy. Anyhow, thank you very much for watching. If you're interested in seeing this without any survivorship bias, let me know. And yeah, I'm looking forward to see you in the upcoming videos. Bye bye.